Hello, everyone. Welcome to our discussion of the money supply and money demand and the effect on R, the real interest rate. This video will cover approximately pages 82 through 100 of the economics chapter, with the exception of inflation. I will do a separate discussion on inflation because it's certainly related to these topics described here in this video, but I think it warrants a separate discussion and elimination, especially given volatility and inflation that is expected to go forward in the near term. So without question, there are a lot of graphs in this page section, okay? And what I think is most important for you to gather is the big picture, okay? So I want you to be a little less concerned with all the graphs and the different names of the curves, and be sure you grasp the big picture, because that's what will be most salient to you in your career after you're finished with the graduate courses. And the most important concept from this section is R, okay? That lowercase r represents the real interest rate that prevails in a given macro economy. And when we talk about the real interest rate, we're talking about the interest rate or the cost of borrowing money after we net out inflation. We'll worry about the inflation piece of this later, but that real interest rate is critical here, because as you can imagine, at higher real rates, companies are less likely to borrow money, to invest in new projects, to hire new people, etc., right? Because it's just more expensive. It hurts profitability if we're having to borrow funds at a higher interest rate. It hits our income statement through higher interest expense. All right, and so that has clear implications for corporate behavior. The reverse is also true. At really low real interest rates, it makes it easier to find good investments. It makes it easier to manage the income statement to borrowing cost, etc. So it's important to know the factors that work together to impact R, because that will impact corporate behavior in your life as a manager dramatically. So overall, I will streamline this discussion for you. So do not be overly concerned with the names of the various curves. Focus on central concepts and connections to the bigger picture. And in my view, there's R, and then there's money supply and money demand. Okay, you want to focus on. So let's start with money supply. Money supply, just the amount of money that's out there to possibly that could even be borrowed or used in an economy. The money supply matters because a loose money supply, meaning more money out there in the market, lowers R. It lowers the real interest rate. If we think of the real interest rate as the price for using money, then we know that, like most goods at higher prices, there'll be a lower quantity demanded, and at lower prices there will be a higher quantity demanded. That's all we're saying here with this first statement. Money supply matters because a loose money supply lowers R. There will be more, indeed cheaper money, and more individuals, more companies will look to access that cheaper money. A tight money supply will increase R. That's what we're going to find from a big picture once we get the intersection of both money supply and money demand on the same graph. Okay, so here I've moved up in our discussion what the exhibit looks like in the book for the money supply. And so while we're here, since this is our first graph in this video, please note that R is on the vertical axis, the real interest rate. Q, quantity, is on the x-axis, as is per normal in this chapter. But here we're talking about price in terms of the real interest rate. That's because to use capital to acquire it, there's a price for that. That price is known as the interest rate. And then with the real money amount, we're talking about the quantity of funds we're accessing. So the money supply is a finite amount of money at any given time. That's why it's a vertical line. Okay. So can we have movements in the money supply? Absolutely. Let me just sketch this with you. If this is the original money supply, then let's suppose there's some sort of macroeconomic activity that causes money supply to increase. An increase in the money supply causes a rightward shift in the curve, which would move it out here. Right? So if you think about Q, the quantity of money or real dollar amount is given here. Let's assume these are the same thing. What that's going to say is that there's more money out here in the marketplace to be acquired and used. At the other extreme, suppose money supply for some reason tightened. The opposite would be true. Okay, we'll look at how that comes together with money demand in a little bit. So let's go back to some fundamentals here. What about the money supply in terms of definitions? What is it? Well, there are two main types of money described in this chapter. Now, there are others, since they're not described here in the book, we won't get into those, but there's M1 and M2. And you may have heard of this before on the business news, but M1 represents cash in circulation. Cash in circulation, so actual cash in your pockets, that kind of thing, plus balances held in checking accounts. So at the individual level or the corporate level or government level. Okay, so checking accounts. Then there's M2, which is even broader. M2 is M1 plus account balances held in savings accounts and money market accounts. So bottom line, M1 and M2, think of very liquid cash. Very liquid cash. So controlling those two aspects of the money supply, as you might imagine, very difficult, right? Very difficult to do. Whose job is it to manage the money supply? You guessed it, the Federal Reserve, at least in the US, and that'll be our focus, okay? Federal Reserve has three main tools to use to help try to control M1 and M2. Because again, M1 and M2, along with some other factors that aren't described in the book, impacts this right here, okay? And why does that matter? Because we know that shifts in the money supply from here to here or here to here can have large impacts on the real quantity of money outstanding in the market. Okay. Here are the three tools used by the Federal Reserve. Short-term interest rates. They impact the rates. They control the rate that they lend to commercial banks, which is then that feeds into the rates that banks offer to individuals and companies. They also control the money supply through the reserve requirement. The reserve requirement represents the percentage of deposits that the commercial banks must hold at the bank. Yeah, if you didn't know that, that's an interesting fact here in the U.S. Banking market. If you deposit $1,000 with your lender, by regulation, they don't have to keep the full 1,000 in cash in the vault. They don't have to keep roughly 10%. That's the typical reserve requirement in the U.S. is 10%. So if they only have to keep 10% in cash in the vault, what are they going to do with the other 90%? They're going to lend it out. And that's going to lead to the money multiplier effect, which we'll look at in the next slide. But the reserve requirement has a huge impact on the money supply. And then third is open market operations, which involves the either purchase or selling of certain government securities that can either take money out of the market by selling securities or by putting money into the market by buying securities. Controlling those three, using those three tools, major job of the Federal Reserve. So here's an example from the book on the money multiplier effect. And again, this goes back to the reserve requirement. Suppose that the Federal Reserve provides $100 in cash to Bank X. Again, Federal Reserve also acts as like a banker to banks, okay? check clearing, lending through the discount window, that kind of thing. What this means then is Bank X must keep 10% of those funds in bulk cash, and they can lend out the other 90%. So in this case, it would mean they can make a loan of $90 to company Y. Let's not stop there. Let's carry this to its logical conclusion here. Company Y will then take the $90, and then they're going to engage in economic activity, right? They're going to purchase $90 worth of goods from, say, Company Z. All right. What's Company Z going to do? Company Z is then going to deposit the money in their bank. All right. Bank W then is going to lend out the most that they can, which is 90%, i.e. they're going to keep 10% of the $90 in the account balance. And that's going to result in a loan of $81 to Company Q. And then on and on it goes. So the reserve requirement has a pronounced effect on the money supply and the overall velocity of money. So far, we just talked about supply. What about money demand? With money demand, there are two primary factors that influence it, as described in this chapter, and that's national income. And as you might have guessed, there's a positive relationship between national income and money demand. As a greater level of money is earned in a national economy, money demand will increase. The second factor, the one we're going to focus on, is the real interest rate. There's an inverse relationship between the real interest rate and money demand. Okay, and that's what you see on the graph to the right, which is straight from the book. And so, as with the money supply curve, R, the real interest rate, appears on the y-axis, and then the real money amounts, or Q of money, is put on the x-axis. And so what we see here is that we've got a negatively sloped money demand curve, which makes perfect sense, right? At higher interest rates, so as we move from this low rate right here to this high rate, right? Money demand lowers. Money demand is lower right here at this rate than it is at this rate over here. Right? That rate will, demand for money will be at this level versus this level at this higher rate over here. So makes perfect sense. It's a typical demand curve function, negatively sloped. Students tend to get confused by this L. L is used here for real money demand. That's why, again, I don't really encourage you to focus too much effort on the names of some of these curves, because they're not that intuitive. Just know that the money demand curve is negatively sloped, because that'll be important for what we look at coming up next. Through putting money supply and money demand together. So to put money supply and money demand together, we need a graph, and we'll continue to use the same graph that plots the real interest rate on the y-axis and the real dollar amounts or quantity of funds demanded or supplied on the x-axis. And so I've sketched that for you. And so what we want to look at in particular is to focus on the equilibrium real interest rate, which will occur where money supply and the money demand curve intersect. And then we also want to think about likely outcomes that can occur from if the interest rate that prevails in the economy is above or below the equilibrium R. First, the equilibrium R. To get the equilibrium R, we need to identify the intersection point between our money supply curve and our money demand curve. So here's money supply. We're going to fix it as a vertical line. And then we're going to show our money demand curve is looking like this. Negatively sloped. Now your book shows the money demand curve that looks like this, straight, negatively sloped line. They also show you a money demand curve that's a little more like this. That's okay too. Okay, that's probably a little more realistic. But here that one has a curve in it, although it is generally negatively sloped. I'm going to stick with this vertical line. All right, the point at which money supply and money demand exactly equal each other, that's our equilibrium real interest rate. At that point, the money supplied exactly equals money demand. Again, money supply in the short term doesn't change, right? It's just what it is. It does not vary with the real interest rate because that's controlled by the Federal Reserve. And it's just a straight line. Now, the Federal Reserve can change it by changing real short-term interest rates, by changing reserve requirement, and by engaging in open market operations. But let's assume we're not going to do that in short order. So money demand is what can change most rapidly. So at the equilibrium real interest rate, money supply and money demand just happen to equal each other. And that will only occur in one spot on this graph, right? Because there's only one intersection point. Now let's think about things that could occur if for some reason the real interest rate that prevailed in the economy happened to be right here. And suppose that this was 2%. When the equilibrium rate is maybe at 1.5%. What would that mean? Well, what that would mean, if we trace out the intersection to the demand curve and the supply curve, right, just drawing a line through these, this would mean that at a 2% rate, there'll still be some demand for money, right? It'll be right here, whatever this level is. Drop it down to this horizontal axis and it gives me a quantity of money demanded of this much. And you see the issue, right? Because the money supply is over here. That would mean there's a surplus of funds available in the market. That would imply an inefficiency of some sort. So if rates are artificially held above the equilibrium rate, companies will not demand the full equilibrium amount of money. And from a big picture, what that means is that they won't invest as much. They won't invest as much. They won't engage in as much economic commercial activity, which can have impacts on national income, impacts on employment, and overall production. Okay, so there's some big macroeconomic impacts here from this. Now, on the other end of the spectrum, what if rates were, for some reason, artificially set so that rates were way down here, like 1%, which is way below equilibrium, right, 1.5. Well, number one, we would hit the money supply the same spot. Money supply is still going to be whatever this amount is. But now the demand for money is going to be really, really high. It's going to outstrip it. It's going to outstrip money supply such that there's a shortage of funds. And so companies will be looking to compete in different ways to access that capital to achieve growth opportunities. And this is where you might see a growth in funding for companies through things like private equity, venture capital, SPACs, right? They find opportunities when market rates are low, but if they can't access the capital at that 1% rate, they're going to try to find the capital at a different to achieve their growth objectives. So overall, do we understand just the basics of money supply and money demand? Do we understand how they come together to influence real interest rates? That's really the most important concepts we want to gather here from this section.